Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, a 2017 and 2018 Fund Data Fund Grade A Plus Award winner. His website, CanadianInsider.com. Welcome back to the show, Ted, in what people are describing as very interesting times.
Well, it certainly is. In fact, as of Wednesday, it appears that the U.S. market is now in a bear market in terms of, technicals. So it's down 20% from its peak. Because, Jim, those of us who've lived through the Canadian equity market for the past 10 years, a bear market is not such a big deal. We're pretty much used to them by now, but I think the psychology south of the border and for those invested in U.S. equities, it is going to be fairly dramatic, and we're obviously not through this yet. So it's certainly we've gone through very interesting times in 2020 so far, and it's not even spring yet.
Now, of course, the coronavirus is getting the blame for this, but after 12 years of setting record highs, it seems, every year along the way, weren't the markets just due for a major correction anyway?
Well, people have been saying that, and I've probably said that a number of times, but you never know what's going to be the catalyst. And this really is something out of the blue that no one could have predicted 6 months ago. So it really was a shocker to the system that looks like, though, it's been the shocker that may have reset things or put a big reset in motion. Now, when we look at what insiders are telling us, because, that's our forte, we look at insider indicators, and then we try and put things in context around that. We look at insider sentiment, and both in Canada and the U.S., it's still in what we'd call a bearish pattern, more bearish in the U.S. than in Canada, I would add. In Canada, it's more of a short-term downtrend, I would say, in terms of what it's pointing to. In the U.S., we've got a long way to go. For example, we put out a report to our clients last night, and we noted that insider sentiment in the U.S., basically, it's been moving up, and what I mean by that is there has been some insider buying as the stock prices have come down. It hasn't been enough buying yet to signal a bullish case, okay? And more concerning, Jim, is that the level of insider buying in the U.S. is less now than it was in the fall when stocks were higher. So that tells us that risks really have changed. I know your listeners are probably saying, well, tell me something I didn't know, but what it gets down to is the fact that there has to be a price reset for those risks, or there has to be an effective policy response to mitigate those risks, and we have not seen that yet at all. On Sunday night, we wrote out in our Canadian report what we were looking for in terms of a policy response out of Washington. The report's called Waiting for Washington, and you can get it on CanadianInsider.com if you're a Canadian Insider Club member. The two elements that we're looking for is not only an economic response from the Fed and from the U.S. government for some sort of stimulus package to keep the economy humming, but a public policy response. And Jim, this is far different than any other crisis that most professional money managers have ever faced. It's something new. All of a sudden, people have to start assessing risks with respect to a disease that, I've seen a lot of knee-jerk reactions out there saying, well, it's nothing, it's just the flu. Well, that's really not, I think, accurate. I'm not a medical specialist myself, but when you look what's happening in Italy, this is not the flu. This does not look like the flu to me in terms of what's happening in Italy. So, one can dismiss maybe, China if one wants to, in terms of what happened there. But when then you see a G7 nation basically up against the wall, like you've seen in Italy, then being able to just sort of dismiss it, it just becomes harder and harder to do. So that's why I think we need to see a public policy response, a public health response out of the United States, and it has to be a dramatic one, because regardless of what you think of the U.S. administration, whether you love them or you loathe them, they've kind of dropped the ball here on the coronavirus, if at least in terms of expectations. There was this sort of approach that we were going to try and downplay it. That yes, we'll deal with it in the behind the scenes, and we'll just let people carry on with their lives. But that is rapidly changing through circumstance. So psychologically, this is going to be a shocker for the U.S. public, and it's going to be that's a shocker to the markets, obviously, in terms of now all of a sudden, no, it's not life as usual. So what we're going to need is some shock and awe economics, and we're going to need some shock and awe public health. So this is a different situation. So once we get that, then I think we can start talking about, are we, near a bottom of this, and, are we near the end? And we'll be looking at our indicators to tell us that whether insiders are confirming that the risks have receded and that the prices have more than compensated for the risks. And we're not there yet, and that's really important. And we try and remind our readers that insiders are typically early when they make their moves, and the ones who've been buying so far, for the most part, have been early. And that's not unusual. This is a contrarians market, but it's also a very dangerous market. And as I said, we have not seen the type of response that we think we need to see out of the United States, who is now on the front lines of this, whether they want to be or not. And we've got to see a shock and awe on the finance side and the public health side.
In Canada, the federal government said it's going to put $1 billion into action here, $250 million into research, the rest into healthcare. Is that the kind of response you were hoping the U.S. might have had by now?
Well, the U.S. needed to do a lot of testing, which it didn't do. They got caught up in a bureaucratic nightmare, which, Jim, we always hear about how bad it is in Canada, right? I hear it all the time, pipelines, City Hall, you name it, right? Canada is not alone with its bureaucratic red tape, right? And in the United States, we saw it in full force in jurisdictional mess up between the Center for Disease Control and the Food and Drug Administration. And that mess up in terms of getting tests out the door, now not only is it having an impact on health, but it's having a massive impact on markets. So let's just try and remember that in Canada we have our issues, but we're not the only ones. And let's hope that we can just sort of all put aside our partisanship, in Ottawa for a while, and yes, hold the government accountable. That's very important, but let's try and do the right thing. In terms of what we need in the U.S., Jim, the horse has left the stable, I'm afraid. I hope I'm wrong. But what we wrote about on Sunday, we said, we're going to have to see mass prohibitions for spectators going to big sporting events like March Madness. And I see that in New York, they're for the games that are being held in New York State, that may be in place, but they're still debating whether they're going to do it in other venues, I believe, if I've got that right, where there's a few sporting events that don't have spectators in. Jim, this is all going to change. It has to change. And, we saw just even in Toronto, the risks of large gatherings. There's been a bit of a warning out with the PDAC. There was someone there who they don't know whether that person was infectious or not. But, it just goes to show you the risks that are involved. And the problem with this disease, as far as I understand it, is tail risk, right? So a lot of people, 8-year-olds and 10-year-olds, they get the virus, it doesn't bug them. It's the 80-year-olds and the 58-year-olds and the 68-year-olds that can really be devastating and very difficult to treat and very expensive to treat if they end up needing hospital care. and it can overwhelm the system. So the tail risks are very high. So that's why we need to see a major public policy response of the United States. Now, there have been some things that have been done, I believe, and I don't know the details, but we've got the Trump administration, I believe, worked out a deal with the insurers to cover costs of testing, because that was not covered initially by some insurers, I believe. So that was a step in the right direction. So, we are starting to see progress. And I have no doubt that once Washington and once the American system gets its head around it and gets in gear, they will fight this situation like no tomorrow. Once they put their mind to something, the Americans are very innovative. They have the resources, and they will be world beaters at dealing with it. But they're just not quite there yet. But let's hope, maybe by the time we talk again, Jim, in a couple of weeks, could very well be a different world. So, but at this point, we have to watch and wait for a public policy response out of Washington that the markets are going to take and go, yes, that's what we were waiting for, that's what we were looking for, and that will probably even be more important than the economic response, which in itself has a lot of risks attached to it.
Yeah, one thing I really think probably hasn't been addressed thoroughly by government, or maybe they're looking at it, is what about all the people, you're an independent contractor, you don't get paid unless you go to work. You're an hourly wage person, you don't get paid if you don't go to work. What about the people who work as hairdressers or nail salons, waiters, waitresses, restaurant cooks? If people don't go to the restaurant, they don't get work, and what's more, if there's a lot of stuff going around, they won't be going to work. How do they pay their bills?
Exactly. And the last financial crisis, in the U.S., the bailout, I don't know. Look, people can assign the weightings they want, but I'll say that 95% of the bailout went to the rich. Okay, those who had assets, those who worked on Wall Street, they were the big beneficiaries. Yeah, there were some earlier, cash for junkers, little things that the average person may or may not have been able to take advantage of. In Canada, we did our own QE. We helped the housing market, so if you could afford a house, you benefited. But if you were a low-income worker, new Canadian that didn't have any money, any Canadian didn't have any money, to buy a house, you were left behind. So policymakers are going to have to think about who they're going to bail out this time. And there's already lineups. Like apparently in the U.S., the shale industry wants a bailout. The banking industry, of course, always wants a bailout in the U.S. because, we couldn't allow banks to go bust. But, they're going to have to really get their heads around how do they help the average person, like you said, not just the average person, but the person who's really being squeezed, right? So, same in Canada. We're going to have to really think that one through. So, what will be very interesting though is whether, and there's a lot to cover in this one, but how the bond market reacts and what this all means for the pension systems in Canada and the United States, primarily the United States, because a lot of pensions plans just got hit very hard. A lot of them are stuffed with bogus, I'm going to call bogus private equity investments, which you can't possibly value. And they, whether they'll be able to extend and pretend those holdings will be interesting, to say the least. But those investments they can value have just gone down enormously. And you've got record low interest rates that are driving up the cost of their liabilities. And how that works is the way the pensions have to estimate their liabilities. Basically, the lower the interest rates go, the more valuable those liabilities are. So, like, if you own if you have a pension plan, and you're expecting your employer to pay it, then as interest rates go down, it becomes more and more expensive for the employer to pay that pension. So, it really becomes a double whammy. Their liabilities go up in these pension plans, and their rates of return go down. So that's going to really put stress on the pension system. Do you bail that out? So there is going to be a lot of demands on the U.S. government to do a big bailouts. The question will be, do investors keep lending Uncle Sam? Do they keep lending Donald Trump? Do they keep lending Justin Trudeau billions of dollars at basically zero interest rates to bail out economies left, right, and center. Today, we saw potentially some signs that the bond market might say no, because we had this massive sell-off in equities, and actually the bonds went down a little bit. So, you know what, though? I'll believe that when I see it. I've been waiting for, some sanity to return to the bond market for many years. I've been wrong for many years. So I believe I will continue to be wrong for many years until proven otherwise on this one. And it's just been the nature of it. The bond bull market has stormed ahead. But are we at an inflection point now? Has the coronavirus, is this the game changer? It may well be, but we won't know we may know in a few weeks. It may not take that long. We'll have to see here. But today was certainly a very, very fascinating, and maybe this may be the historic day, the day that the WHO declared coronavirus a pandemic, the day that apparently Donald Trump is going to address the nation about, this could mark the bottom, but I think a lot depends on what the U.S. government does. And in fact, I would think that maybe there's still, my best guess is this is the Pearl Harbor of the coronavirus scare, and we're not quite at the midway point. And midway is around when stocks bottomed in World War II. We're not quite at the midway yet. I hope this is the midway. I hope the pandemic is the midway, and maybe the Chinese experience was a Pearl Harbor. We'll see, but we'll have to see what the response is out of Washington. I think that will set. That will be required for the foundation for a return to normalcy. And what normalcy is? That a new normalcy, another new normalcy, or are we going to go back to sort of fundamentals where, in fact, investors start demanding to be paid from Uncle Sam, from the Canadian government to lend the money? These are questions that we'll be getting answers to maybe over the next few weeks.
We'll have more with Ted Dixon right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Ted Dixon. Ted, are people just going to bail into gold without thinking about it, and is it a good place to be?
Well, the gold market is often, touted as a safe haven, and then when you have days like today where gold sells off, people wonder, well, why did gold go down? Well, I don't profess to know exactly why gold went down, but one has to remember that sometimes people have to cash in their insurance policies, right? So when you think of a lot of sovereign wealth funds, countries around the world who stocked up on gold but have had hard times, maybe they have to sell some, right? Russia is now and I'm not suggesting Russia's selling its gold, but you could see why maybe Russia would have to sell some gold at some point to fight this crude oil war that they're launching with Saudi Arabia. Now, I don't think they're quite at that point yet, but the point being is that sometimes one has to sell their gold to cover bad circumstances, and we're probably seeing a little bit of that, whether it's Iran or Venezuela or who knows who the suspects are, who the culprits are, but pretty clear who some of the suspects are who might be having to sell. And of course, then there's individual players who have made money in gold and are selling their gold to pay off some of their losses. So I wouldn't read too much into the gold market here, except that we are going to have more volatility. And thinking back to 2008, I remember it well. I lived through it well. I lived through it. I don't know if I lived through it well, but I lived through it, and gold got hit at a hard point, and some gold stocks got massively hit. I remember, for example, I believe it was Nova Gold, that it got hit very, very hard. There was, insiders I believe had to sell at that point, and, I apologize if I've got this wrong off of memory here. But, that did offer opportunity for new investors to come in. Thomas Kaplan came in and when the stock was trading down low, and, basically been with it ever since. And, now it's, on the cusp of potentially being, and I'm not recommending Nova Gold, by the way. I'm just a story about, how it was on the ropes back in 2008, 2009, but it has survived, and with a new vigorous shareholder came in and saw opportunity in that, and the stock is now trading over $10 and looking to develop a massive gold deposit in Alaska. So there will be opportunity, but it's not immune. Unfortunately, the gold market is not immune from these sell-offs, and some players do get shaken out during this bout. And looking at our indicators in the gold market right now, we saw a mini sort of flashing topping pattern in terms of insider sentiment, and I would call it sort of a short-term topping pattern in February. We're not quite at a bottoming pattern yet. There could be still some weakness. Our indicators tend to be coincident indicators. What I mean by that is that they tend to confirm something that's happening at the time. They don't forecast or pinpoint when it's going to happen. So, we can't say that at this point. All I can say is I don't think we're at a necessarily a bottom in the gold stocks, but the longer term trend is still positive. And the idea here is I think we're probably closer, to a bottom in the gold stocks than a bottom in the major market. But who knows? It's there are scenarios where you could make a case where the overall economy is going to get a jolt from massive stimulus, and that's going to, so the other stocks will outperform the gold stocks. But look, that's all what ifs. At this point, generally speaking, we're in a very high period of stress, and we're going to get a probably pro-inflationary response from authorities that should be gold positive, but we just have to be mindful that along the way, there's going to be people that are forced to sell, and usually, if you can be a buyer when someone's forced to sell for non-fundamental reasons, that's not usually a bad time to be on the other side of that trade. Where you don't want to be on the other side of the trade is when the seller knows something that you don't, and they're selling you a lemon, and you think you're buying an orange. And I don't think that's the case with the gold market right now. We're seeing some forced liquidation, but so it is going to be tough on those who've invested in the gold market and see on days like today, and they see their shares trading lower. Now, I would say I follow a few junior gold miners myself, and some of the ones we've written about, and some of them are trading right around their 200-day moving averages. So it'll be very interesting to see if they can hold it. It's been quite volatile today on a number of these stocks. I would definitely take a look and see if they can hold their 200-day moving average over the next few days, and if they can, then we could be set for a reflationary move up here as governments around the world and central banks really try and pump the liquidity into the system. And if they're smart about it, and I would apply the Napoleonic Code on that one, they will try and get the money in the hands of those people that you were asking about earlier, Jim. The small contractor, the hourly worker, the worker who isn't going to go, the Starbucks shift worker who, instead of getting 20 hours a week is now only getting 5 because fewer people are going to Starbucks or whatever coffee shop. I'm not trying to promote anyone in particular, but you know what I mean. There's a whole range of people in our communities that are going to be hit by this. And surely to goodness, Jim, the Federal Reserve and the Bank of Canada and the policymakers have got it through their thick heads that they can't just bail out Wall Street, that they've got to be thinking about the average worker. and the citizen here who they're supposed to be working for. Well, at least the government is. The Federal Reserve works for Wall Street, basically, but that's another story. Surely they've learned their lesson now, and we'll have to see. We'll see if they just go to their same old tricks and do QE. I mean, Jim, like, what is the point of QE? And, QE, I'm sure your listeners know, it's when they're buying bonds. They go and they buy 10-year bonds, and they'll keep the rate down. Well, that helps Wall Street. It doesn't, it helps those who can go out and finance, who want to go buy a 30-story office tower, can go get the financing for that. That's great for those people. But I'm telling you, if you're working at Tim Hortons and you're hoping to get an extra 2 hours of shift work, that's not going to help you at all. It's just, you're just the forgotten victim of the downturn, while all the money goes to help out, the high flyers, in the financial sector. So, let's hope that there's a different approach taken this time, and we should be able to, again, find out in a couple of weeks. And if they do, if the policy response is more grassroots, it's going to be more pro-inflationary. Because, Jim, if you're helping shift worker who has to go, who's begging for another 2 or 3 hours, to get, another $10 an hour or $15 an hour pay, if you put some money in that person's pockets, they're probably going to spend it. But, doing QE to help Wall Street and to help hedge funds to boost their profits so that they can make another X million dollars, what are they going to do? They're going to take the money and they're going to buy a resort, a second home in the Caribbean, right? That's not going to do anything for the economy. So have they learned their lessons? We're going to have to wait and see on that. Let's hope they have.
We'll have more with Ted Dixon right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, the Canadian oil and gas sector was already hit hard by a slowdown in the world economy before the virus meltdown on the markets has plunged oil down into the $20 mark in some places. What can be done for them, or is this a situation that's beyond the Canadian government's help?
Well, Jim, that is a follow-up, I guess, to the rant I had on your show 2 weeks ago. For those who are interested, flip back in the archives and you'll get my rant on what we should be doing on climate change and how we should be looking at the Canadian oil patch as a solution as not as a problem. That would be the first thing that our government could do, but unfortunately, I'm not holding my breath on that. Okay, so now what can they do? Well, they can do their usual bag of tricks and give a handout here and a handout there. I think that really the best we can hope for out of this current government in Ottawa, or any government in Ottawa actually, realistically, is to provide assistance to the workers, to keep them available for when things turn around, to beef up, the unemployment employment insurance system, and to, put a strategy together to invest in a better, a more carbon-free industry, and to make Canada a leader in that. And again, that gets back to what we were talking about last week, because those would be high-paying jobs that would help set Canada apart from these other backwaters like Saudi Arabia when it comes to climate change. And for some reason, the environmentalists in this country, they want to shut down our industry and just yield market share to countries like Saudi Arabia. I think it's terrible. I think it's stupid. But, they somehow managed to grab the moral high ground, and it's just disgusting. I just find it totally disgusting. It's my own personal view that to be so harsh on the Canadian industry without giving equal treatment to some of the other actors in the global economy out there. And why should we be penalizing Alberta when we're importing oil from some of the worst climate change offenders in the world on the East Coast? It makes absolutely no sense. And as far as anyway, I'm kind of moving back into another rant again, but let's just have some common sense here as Canadians and say, look, there is a way we can fight climate change, but yes, the oil patch is going to be part of the solution, and we're going to put some money in it right now because the bond market is allowing us to borrow money for free anyways, and this is about the future. So, you can make an argument, even as a conservative, hello, Peter MacKay, and others who are running for the leadership of the Conservative Party. This is about the future. It's about the children, about our children. It's about our grandchildren. It's about the climate we want to live in. Now is a good time to make those investments. And I know a lot of people don't believe in there's man-made climate change. You know what? When it comes to elections, it's perception that is reality, and the middle voter, middle Canada voter, they believe it. You got to win those voters if you want to win power. So that's the reality. So if you don't have a strategy to win those voters over, you're going to allow the other side to win all the time, and nothing's going to get accomplished for the oil patch. I can assure you of that. It's just going to be more of the same that we've had over the past 3 or 4 years. And even so, I would really kind of encourage those people who are kind of on the fence, really don't think that Canada, because I know there are a lot of people still in the Conservative Party and in other parts of society in Canada who do not think we should have a climate change strategy. Well, then by doing that, you're essentially yielding the whole territory over to those that are going to try and wipe out the oil patch as the solution, which of course is just stupid because Russia and Saudi Arabia, are not going anywhere. And we've seen that pretty clear in the last few weeks that they're willing to pump as much oil as they need to.
Ted, thank you so much for chatting with us.
Jim, it's been my pleasure.
My guest has been Ted Dixon, CEO and co-founder of inkresearch.ca, his website, CanadianInsider.com. If you have any questions for Ted or any of our other guests, you can send them to info@HowStreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.